Hello, I'm Ken Moraif, Senior Advisor at Retirement Planners of America, and this is our weekly market update for the week ended June 21st, 2019. And as we described to you in last week's video, the Federal Reserve did not raise, or rather lower interest rates, but the language that they used left the door open to lower interest rates. And of course, as we also described last week, that would happen is that the market, the stock market, the S&P and the Dow both responded with glee to the fact that the Federal Reserve may raise or lower interest rates in the future. We believe that the Federal Reserve may lower interest rates in July or September, and potentially more than once for the rest of this year. Now, as we also described to you in previous communications, the Federal Reserve follows from the front. They don't lead. So the bond market essentially tells the Federal Reserve what to do, and the Federal Reserve generally does what the bond market says. And when we say the bond market, if you look at the 10-year Treasury yield, you'll see that not too long ago it was 3.25%. And now, as the market closed on Friday, it's down around 2%. So it has come down significantly. So what the bond market is telling the Federal Reserve is, we want you to lower interest rates by 1.25% from where it is now. Think about that. So that's a big deal. So what does that mean? Well, from an investment standpoint, the two areas, stocks and bonds. So let's look at bonds first. Bonds tend to benefit from lowering of interest rates. As interest rates go down, generally speaking, bonds rise. So this would be a good thing from a bond market perspective. And we've seen bond prices go up here of late with the anticipation of that interest rate drop, which hasn't happened yet, but anticipation. The other thing that is interesting to look at is what has happened in the stock market. What has the S&P 500 index done in previous periods when the Federal Reserve has started a new cycle of lowering interest rates? Okay, because what they've been doing up until now is they've been raising rates. That's been the cycle we've been in. So now if they say they're going to lower, they're changing that. They're going into a cycle of lowering interest rates. And there's a company called CCM Market Model, and they looked at what has the S&P done, the performance of the S&P in periods when the Fed started a new interest rate lowering cycle, and it was in a non-recessionary period. And that's important because depending on whether it's recessionary or non-recessionary, the market would behave differently. And I think we could make the argument that in fact we are not in a recession currently. The economy seems to be strong, jobs are plentiful, and wages are rising, consumer confidence is strong. So we would say that we're not in a recession right now. So a non-recessionary Fed rate cut has happened 6 times since 1971. It happened in 71, in 84, 87, 89, 95, and 98. And what's very interesting about this is that in 30 days, 60 days, 90 days, 6 months, 9 months, a year, and 2 years, in every single one of those periods, 100% of the time in all 6 of those cases, the S&P was up. And the average after 1 year was 16.5%. And over 2 years, the average, are you ready? 40%. So what does this tell us? It tells us that we are very bullish because our view is that the Federal Reserve is going to lower interest rates. And when they do that, the 6 times they've done it in a non-recessionary period, we've had phenomenal returns in the S&P that followed. So we're bullish. We anticipate a rate cut. So let's all say thank you to the Fed for many happy returns.